Starbucks stock is down 17% today after the business reported its earnings. And on my channel, I have recently said that Starbucks could be looking cheap based on the company selling near its all-time low price to operating income ratio and projecting strong revenue and operating income growth this year. However, the business put out a pretty weak earnings report yesterday and lowered its guidance significantly. So in today's video, we are going to go through Starbucks earnings, and I will point out the highlights, why the stock is falling, and if it is looking like a buying opportunity today. So with that being said, let's just hop right into the video. So let's start off this video by taking a look at Starbucks' previous guidance for 2024 before they put out these earnings. And here we can see that they were expecting global revenue growth of 7 to 10%. They were also expecting their operating margin to continue expanding throughout the year, and they were expecting earnings per share growth of 15 to 20% throughout the year of 2024. So this was a pretty bullish guidance for 2024, actually. They were expecting strong revenue growth, continued operating margin expansion, and earnings per share growth above 15% for the year. So now let's take a look at Starbucks results that they just posted yesterday. And this says, Q2 consolidated revenues down 2% to $8.6 billion, driven by a complex operating environment. So revenue for the second quarter year over year was actually down 2%. Down here it also says global comparable store sales declined 4%, driven by a 6% decline in comparable transactions, partially offset by a 2% increase in average ticket. So global comparable sales are down year over year by 4%, with a 6% decline in overall transactions. So it seems like people are not going to Starbucks as much, and they are seeing a 6% decline in global transactions year over year. Then this says North America and US comparable store sales declined 3%, driven by a 7% decline in comparable transactions, partially offset by a 4% increase in average ticket. Then in international, comparable same-store sales declined by 6%, driven by a 3% decline in both comparable transactions and average ticket. China comparable store sales declined 11%, driven by an 8% decline in average ticket and a 4% decline in comparable transactions. So over in China, Starbucks has actually had to lower its prices by 8% year over year, and it looks like to continue driving sales. So right away, this is not a very good start to the overall earnings report for Starbucks because again, they were projecting strong revenue and earnings per share growth for 2024, and now the company is losing sales. Moving on to the next screenshot that says, GAAP operating margin contracted 240 basis points year over year to 12.8%. Non-GAAP operating margin also contracted 150 basis points to 12.8%. GAAP earnings per share declined 14% year over year as well. So instead of earnings seeing growth of 15%, earnings actually declined by 14%. And instead of the operating margin continuing to expand throughout the year, right now Starbucks is actually seeing its operating margin decline by quite a significant amount as well. So this earnings report is really not looking good for Starbucks so far. However, their loyalty program members did increase by 6% year over year. And then down here, the business says that their brand has limitless potential, which I actually do kind of see as a red flag because no brand has limitless potential, okay? So I don't know if this was like a little bit of an exaggeration, but I do pay attention to the words that management is saying, especially when they're actually having to lower the price of their product around the world to continue driving sales. When a business has to lower its prices, it's typically a sign that maybe its brand is not strong enough to continue increasing prices, and maybe its mode is actually being weakened. So for Starbucks to say that their brand has limitless potential on a weak quarter like this is a little bit interesting to me. Now, moving on, Starbucks breaks down its North American and international segments. So here we can see that change in comparable store sales were once again down 3% year over year in North America. Change in transactions was down 7%. However, they did manage to increase their prices in North America by 4% year over year, which did kind of offset that overall transaction decline. Revenues basically came in flat year over year, and operating income did drop by roughly $80 million year over year in North America. Overall, this means the operating margin in North America declined as well. Now moving on to the international segment of the business. Change in comparable store sales declined by 6%, change in transactions declined by 3%, and change in ticket declined by 3%. However, if we take a look at the store count internationally, it grew by 9% year over year. So Starbucks is actually opening a lot more stores around the world, and despite them opening more stores around the world, they're still seeing their overall revenue internationally decline, which I do think is kind of a bearish thing for this business as well. Revenues declined by 5% internationally, and operating income declined by 26%. And the operating margin internationally is down by 3.7% year over year. So the operating margin took a massive hit in the international markets for Starbucks. I also have a screenshot right here from FinChat, which does show the total company operated stores and total licensed stores every single quarter. And we can see that the total stores for Starbucks is still growing. However, the revenue is no longer growing with the total store count. So again, that is kind of a bearish thing for Starbucks overall. Now moving on to the actual full income statement here, we can see that revenue came in at 8.56 billion versus 8.7 billion last year. So it is down slightly year over year. Operating income also declined by about $230 million year over year to about 1.1 billion. And at the bottom of the income statement here, we can see that Starbucks did buy back roughly 17 million shares year over year. So the company is buying back shares with some of the cash flow as well right now, while the stock is down. And that is actually kind of a good thing to see. Now, speaking of cash flows, if we move on to the cash flow statement, which is my favorite thing to take a look at, right away we can see that stock-based compensation came in at 173 million, which is up slightly year over year for Starbucks. However, Starbucks stock-based compensation is actually quite low, and I do see this as a good thing for the business, and it was one of the reasons why I was initially interested in this stock. So if we take a look at the stock-based compensation of 173 million versus the operating cash flow of $2.9 billion, it tells us that the stock-based compensation is a very low percentage of the company's overall operating cash flows. So there's not a lot of dilution happening to shareholders relative to the amount of operating cash flow that the business generates. And again, I do actually think that this is a good thing. Another good thing is we can see that Starbucks operating cash flow did increase in the first 6 months year over year by about $500 million, which is a pretty significant increase to overall operating cash flows. So despite Starbucks' overall revenue kind of seeing weakness right now, the business's operations are producing more cash flow year over year, and again, that is a good thing. Capital expenditures are up roughly 20% year over year to $1.25 billion. So in the first 6 months of the year so far, Starbucks has produced about $1.6 billion in free cash flow, and that is total profits for the business. So it is still generating billions of dollars in free cash flow, and it is still a profitable business. Down at the bottom of the cash flow statement, we can see that so far in the past 6 months, they paid out about 1.3 billion in dividends and bought back about $1.3 billion worth of stock. In total, this is about $2.6 billion returned to shareholders. However, remember, the company only produced $1.6 billion of free cash flow in the past 6 months, so they did pay more dividends and buy back more stock than they generated in free cash flow. And that ultimately resulted in a net decline of the company's cash position of about $790 million here at the bottom of the cash flow statement. So the company's dividend is well covered, but they did use some of the cash position to buy back stock. That is basically what Starbucks is doing with its cash and cash flow right now. All right, now let's move on to Starbucks' current guidance for 2024. So really compare this to their previous guidance for the full year and take a look at how much this has changed now, okay? US comparable same-store sales growth is now expected to be low single-digit to flat. So they're not really expecting same-store sales growth in the US now. China comparable same-store sales growth is expected to see a small decline year over year. So their store sales over in China are expected to decline now. Global store growth is projected to be 6%, 4% in the US, and 12% over in China. So they are still continuing to expand and open up more stores around the world. However, global revenue is now projected to grow in the low single digits. Now remember, their previous guidance was between 7 and 10% revenue growth for the year of 2024. So they have massively lowered their revenue guidance for 2024 now. Global operating margin is approximately going to be flat, so there's no longer projected to be any operating margin expansion for this year, and they are currently seeing their operating margin decline, whereas again, they were projecting operating margin expansion for this year. And then lastly, we can see non-GAAP earnings per share is expected to be flat to low single-digit growth, whereas previously they were expecting 15 to 20% earnings per share growth in 2024. So Starbucks massively lowered their guidance for the year of 2024 in this quarter, and that, in my opinion, is why the stock is down so much today. And this was a large decline to Starbucks guidance for the year. Again, they had a pretty bullish outlook for 2024, and then after this quarter, they basically scrapped that entire outlook and said, hey, listen, our business is essentially going to be flat year over year instead of seeing strong revenue growth and earnings growth and margin expansion. The company is not seeing that, and they really lowered their guidance. So in my opinion, I do actually think that the sell-off in the stock is warranted today because the stock looked like it could be offering value or looking cheap previously before this earnings report based on their previous guidance of strong growth in 2024. Now that the business is saying that it's not going to grow this year, again, it's kind of changing things. And I do think that investors are now reevaluating the stock based on the outlook today of basically no growth for the rest of the year. Now, additionally, Restaurant Brands Inc., which does own a lot of different companies around the globe, including Tim Hortons, which is a Canadian favorite. You gotta love Tim Hortons up here, right? Coffee's not that great, but it's just like a staple. You gotta love Tim Hortons. Anyways, getting off topic. Tim Hortons is a Starbucks competitor, though. They are a coffee chain up here in Canada, and in Canada, I would actually say that they are Starbucks' #1 competitor. Tim Hortons is also trying to expand across the globe right now, especially over in Hong Kong and over in China. So I actually think that Tim Hortons versus Starbucks right now is a very fair comparison to see how these two businesses are doing, and if Starbucks' decline is a Starbucks specific issue, or if Tim Hortons' business is also kind of seeing weakness right now. And Restaurant Brands, which does own Tim Hortons, put out their earnings release yesterday as well. And here we can see that Tim Hortons' system-wide sales growth was up 7.8% year over year. So the company is still seeing strong revenue growth year over year. And on a comparable sales basis, so same-store sales year over year, Tim Hortons sales are up 6.9% or basically 7% year over year. So Tim Hortons is clearly outperforming Starbucks right now across the entire world. And what this kind of suggests is that Tim Hortons is actually taking Starbucks market share, and actually suggests that Starbucks is losing market share globally in the coffee and coffee shop industry. So this is another pretty bearish point for Starbucks, because this kind of suggests that it's not an industry thing, it is very much so a Starbucks branded thing. I also went through Starbucks Transcript for the earnings call yesterday, and I found something pretty interesting. So this analyst right here, just to summarize everything, the analyst basically asks, are you still expecting 15% earnings per share growth over the next couple of years? Like in 2025 and beyond, are you expecting to grow your earnings at that 15%, which was your previous guidance? Then the CEO comes in and says, Andrew, thank you for your question. Everything we've seen, I know that we had a tough quarter, but everything we see in terms of the opportunities that lie ahead, as you look at the opportunities we have, the innovation that we see in terms of the pipeline going forward. If you look at the productivity opportunities, the store count opportunities, we believe we'll be back. And we see no change in the long-term outlook that we set earlier in this business. So basically the CEO came on the conference call and said, we are still expecting 15% plus earnings per share growth in 2025 and over the long term on an annual basis. Now, I gotta be honest, I think that this is way too optimistic, okay? And this is actually a red flag for me. So one thing that I discuss a lot on my channel is you want to pay attention to the words that the management is saying, and you want to see if they are kind of acting more as like a salesman for the stock, or actually being honest and transparent and just upfront with the market and with investors. And what you want as an investor is for the management to just be straight up with you. If there's issues going on with the business, you want them to tell you that, and you want them to just be straight up and be like, yeah, you know, we're having a weaker year. Maybe our long-term guidance isn't going to be met now because we are struggling today. We're working our best, but right now we are going to lower our guidance and just kind of be conservative with our expectations. That's kind of what you would want to see from a management, or at least in my perspective, what I want to see from management is transparency like that and lean more to the conservative end, especially if the business is seeing some weakness right now. However, the CEO just came on and said, yeah, we're still expecting 15% plus earnings per share growth in 2025 and beyond. That is just, it's just too optimistic for me. Based on what is currently happening with this business, with it kind of seeing some struggles across the world and seeing its revenues decline, its average ticket decline, I'm just not very optimistic that Starbucks is actually going to achieve 15% plus earnings per share growth in 2025 and on an annual basis beyond that. So just to summarize my thoughts here, I actually do think that this is a red flag from the CEO. And I think that he is kind of trying to sell the stock and kind of be like, you know what, everything is fine over the longer term with our business, even though there are some real issues going on with Starbucks right now. So now let's head over to Stock Unlock and talk about Starbucks price today after the stock is now down 17%. So including this 17% decline to Starbucks share price today, the market cap for the business is actually around $83 billion at the time of recording this video. So if we enter in $83 billion in our calculator and we divide this by the $5.5 billion in trailing 12 months operating income now, we can see that Starbucks is trading for a price to operating income of about 15 today, okay? Now we're going to enter in $83 billion once again, and we're going to divide it by the operating cash flow that Starbucks produced in the trailing 12 months of about $6.5 billion. This means that Starbucks is trading for about 12.8 times operating cash flow today. Now, if we go and take a look at Starbucks' historical price to operating income, we can see that its average since 2007, so over the past 17 years, has been about 24.5. So its current price to operating income is 15, which is well below the company's historical average price ratios. Additionally, we can see that here in the stock market crash of 2020, Starbucks price to operating income got down to about 17. So the stock is trading for a lower price to operating income today than it was during the stock market crash of 2020. In fact, the last time that Starbucks was trading this low was during the Great Recession in 2008 and 2009. The lowest its price ratio has ever been was 10 in 2008, and then it did recover to about 13 in 2009. So basically, Starbucks is trading for a 17-year low price to operating income ratio that it has not seen since the financial crisis of 2008. This right here could suggest that Starbucks stock is actually looking quite cheap right now. If we also take a look at the historical price to operating cash flow, its average is about 25, and again, Starbucks is trading for about 12.8 today, and the last time that Starbucks was trading this cheap was around 2010. So it is at about a 14-year low price to operating cash flow as well. We can also see here that Starbucks is offering a 3.11% dividend yield today on the cost of the shares. Now, if we take a look at the historical dividend yield of this business, this is actually an all-time high dividend yield for Starbucks stock. The previous high was here in 2018 at about a 2.88% dividend yield. So now the dividend yield is actually at an all-time high. So that could be another indicator that Starbucks stock is looking cheap today. However, it really does come down to if this business can continue to grow in the future. Like if it is seeing some serious headwinds and its moat is being attacked, its margins are compressing, its revenues are coming down, then that really changes the future outlook of the business and its valuation today. So what I personally would want to have confidence in before buying Starbucks stock is if the business's revenues and operating income and profits are going to remain intact and actually continue to grow over the long term. Now, personally, I cannot confidently answer that question, and for that reason, I have not purchased Starbucks stock, and that is why I am not really interested in the stock today. It really does look to me like Starbucks' moat is being attacked and successfully breached by competitors such as Tim Hortons. There is a clear indicator here where Starbucks business is seeing weakness relative to its competition in the industry. And again, that can suggest that its moat is being crossed, in conjunction with revenue declining and margins compressing as well. So I do think that there is some caution here that investors really do need to consider, and you do really need to consider the moat of this business and if you are confident on the long-term potential and growth of it going forward. However, with that being said, the stock is clearly trading at a 17-year low priced operating income and a 14-year low priced operating cash flow, while also offering the highest dividend yield that the company has ever offered. It's also still producing billions of dollars in free cash flow, and the dividend is well covered by free cash flow. So I don't think that the dividend is at risk. I also don't think that this business is at risk of going bankrupt or seeing any really significant financial event. The question really just comes down to, can this business recover and can it get back to growing once again in the future? And that's the question that everyone really has to answer individually. And again, for me, I don't have that conviction or that confidence in Starbucks stock. So it's going to be a pass for me, but I just wanted to cover this one on the channel because I did recently say that it was looking cheap if the company could maintain and hit their historical guidance. With that lower guidance though, that really changes the story. And I do think that the stock deserves to be down 17% today. But that is going to wrap up the video today. And if you did enjoy this video, then please remember to leave a like on it. And if you want to stay up to date with more earnings as they come out over the week, then make sure to subscribe to my channel because I do my best to cover as many earnings on the channel as possible. But with that being said, thank you all so much for watching. As always, I truly do appreciate it, and I really hope to see you all again in my next video.